This is Kyle with Fundamentals of Finance, here with my stock market outlook for 2023. But this is not going to be like your typical stock market outlook for two reasons. First, no one has a crystal ball and no one can tell you exactly what's going to happen in the future with any level of certainty, although not everyone will be willing to admit that. And second, my main goal for this channel is to teach you how to invest. And investing is not just about anticipating what's going to happen, it's also about determining what impact that will have on the market. And that is an area where I can more reliably help you. And some of the things you'll learn in this video will be useful well beyond 2023. So over the next few minutes, I'll take you through some of the key things to watch for 2023 and help you think through the potential stock market impacts of each of them so that you can make better investment decisions in 2023 and beyond. Let's get started. For most of 2022, the key driver of the US stock market has been rising inflation and the Fed's rate increases designed to lower it. So it makes sense to start there. With respect to the stock market, it's important to note that investors are often very short-term oriented and narrowly focused. They lock in on one thing and often fail to see the forest through the trees, so to speak. That one thing that investors focus on always changes. And it's the investors who can look a little bit further out to what the market will be focusing on in the future that can get ahead of the market and find the best investment opportunities. For example, 2021, no one cared about inflation. The only thing they paid attention to was COVID. Then in late 2021 and 2022, the market became hyper-focused on inflation and rates. Inflation and rates. Nothing else matters. But looking ahead, we're unlikely to have another big food and energy shock. House prices and rents are likely to be stable or falling. We'll be one more year removed from all the inflationary stimulus spending, and higher interest rates are likely to be weighing on the economy and job market. So in 2023, inflation is all but guaranteed to come down. We'll go all the way down to the Fed's 2% target? Probably not, because sticky service inflation could remain stubbornly high. But it should fall enough for the Fed to at least stop increasing interest rates. That would likely mean the valuations on growth stocks would stop getting crushed like they did this year. Bonds would be in for a rebound with higher starting yields and fewer rate increases, and the market would likely shift its focus to something else. What would that be? I can't say for sure, but my base case is that I'll start looking ahead for signs of an economic and stock market recovery. Needless to say, that would be a good thing. But before we get to a market recovery, I do think we're likely to have a mild recession in 2023. Now, we don't invest in the economy, we invest in the stock market. So I won't spend too much time opining on whether we'll have a recession or not, but for a 2023 outlook, I have to at least mention it. In short, I think we will have a recession because high demand for services post-COVID and a shortage of workers in service industries has led to an increase in service inflation. Service inflation is sticky because it's driven by wages, so it probably won't slow down until wage growth slows down. And wage growth probably won't slow down until unemployment goes up. And unemployment won't go up until we have a recession. You also have a bunch of indicators flashing red, like an inverted yield curve. That typically predicts a recession. And every time inflation has hit 5% in the last 50 years, we've had a recession. So it probably will happen. That's not exactly a bold call, but even if we have one, I think it'll be mild because the labor market is super tight, which in English means it's really hard for employers to find workers. We could see some job postings get removed and some layoffs, but overall there could be fewer job losses in this recession than in most of them, which could lead it to be more mild. Stimulus programs are also still feeding through to the economy, and people and businesses have a lot of extra cash, which could all help cushion the blow in a recession. Something to watch will be how the Fed reacts to the inflation numbers that come in. If it stays too high and they have to keep raising rates more than expected, that could lead to a worse recession. Another big topic in 2022 was the energy crisis, which has been especially bad in Europe since the war in Ukraine broke out. There will be a lot of moving parts on this one in 2023, and regardless of where prices end up, energy and other commodity markets are likely to remain volatile. Here's what will have the biggest impact, and remember, it all comes down to good old supply and demand. The most impactful and least predictable is the outcome of the war in Ukraine. Of course, if it ends, that's probably hugely positive for European equities and it will likely drive energy prices down a lot. But how much exactly is highly dependent on the outcome of the war. I don't think Europe is just going to go right back to relying on Russia for all of their oil and gas. In fact, they can't because Russia blew up the Nord Stream pipeline, which was the primary way they sent natural gas to Europe. Certainly though, there are many ways that an end to the war would lead energy prices to fall. But when the war will end and how that plays out are anyone's guess. There's also been massive underinvestment in production of many natural resources like oil. And there's a real chance that puts a floor under prices in 2023 and maybe beyond. It would not at all surprise me to see oil prices back at $100 a barrel at some point next year, particularly if the global recession is a mild one, or if there's no recession recession at all. Beyond an end to the war in Ukraine, a worse than expected recession that sapped demand for oil will be the most likely reason I can see that oil prices would keep on falling. The real kicker to that though is China. A reopening China, which is the world's largest consumer of oil and has been in a major economic slowdown in 2022, could be another cause of upward pressure on oil and other commodity prices. Net, I think the underinvestment in supply is known, and the China recovery is highly likely. Those are the main factors that could keep commodity prices high. Of the factors that could lead energy prices to fall, the end of the war in Ukraine is unpredictable, and a worse than expected recession is less likely. So we'll have to see how things play out, and volatility is likely to persist throughout the year. But net, that leads me to believe there's probably still more upside in energy and commodities in 2023. China is another huge factor that is probably not being talked about enough in the US, because, you know, Americans, we only care about the USA. And it would not surprise me at all if the Chinese stock market was the highest returning major stock market in the world in 2023. Of course, this isn't like sports, where you look at the best team and say, they'll probably win the championship, but if they don't, they'll at least make the playoffs. This is different because I think China is likely to be the best market in 2023, but there's a huge risk that they could also be the worst stock market of 2023. So even though I'm optimistic, I would still proceed with caution. If you haven't been following what's going on in China, I recommend going back to my Why I'm Investing in China videos for more details on the risk and opportunities. But here's the Cliff Notes version to catch you up for now. The Chinese stock market fell more than 62% from its high in February 2021 to its low in October 2022, as a flurry of new domestic regulations, worsening US-China tensions, a property market collapse, and adherence to a strict zero COVID policy for most of 2022 dealt the market blow after blow until it was looking like good old Rocky Balboa. But could China finally be ready to make an epic Rocky-style comeback story? It's actually quite possible. While most of the world is tightening monetary policy and likely heading into a recession, China could be easing policy and coming out of one. In November, protests started breaking out because people were fed up with strict lockdowns and mass testing requirements. Worried about the economy and maintaining social stability, the Chinese government completely changed their stance, essentially dismantling their dynamic zero COVID strategy overnight. There's no more mass testing. Actually, it's hard to even find a place to get tested if you want to. Quarantine rules are much more relaxed, travel restrictions have been eased, and the state-sponsored media has switched from daily stories about the horrors of COVID in the United States to telling people Omicron is really not that big of a deal. The government also just made a bunch of super positive comments about their vision for next year. They're making it a priority to restore market confidence, which means 2023 could be a pro-growth year. To top it all off, the pro-China KMT party just won a landslide election in Taiwan, which all else equal means the noise around that whole situation could die down a bit in 2023. So it's an excellent backdrop for Chinese equities, to say the least, and they're coming off a major market downturn, significantly worse than any other major country has experienced in the last 2 years. But there are a few reasons for caution too. US-China tensions are not just gonna go away. Nothing is stopping the US from continuing to be the aggressor and poking the bear here. And it wouldn't surprise me at all if the petty politicians in the Republican Party felt the need to visit Taiwan to one-up the incredibly stupid move by Pelosi in 2022. China is also reopening their economy when not enough elderly people are vaccinated and few people have natural immunity. So it's unlikely the reopening will be linear. Recent talks of stimulus to come have been really promising, but actions speak louder than words, and we have yet to see what will actually be put in place. All told, most signs point up for China, which would not only be good for Chinese stocks, but also for many European and emerging market stocks and for commodity prices, all of which are heavily influenced by demand from China. Even US companies that sell a lot into China, like Apple, Nike, and GM, could stand to benefit on some level. So where does this all leave us? Well, there are a few days left, but as I'm recording this in late December 2022, the market has seen a significant recovery in the past few months. Given that we're not out of the woods yet, and we're likely heading into a global recession, it wouldn't surprise me if there was some early year downside from here. But as long-term investors, it's often ill-advised to try to get too cute with your short-term timing. Will there be a recession in 2023? I don't know. Will the war in Ukraine end in 2023? I don't know. Precisely how high will the Fed raise rates? I don't know. There's a lot we don't know. But given everything that we do know, it's likely that even if there's some more near-term downside due to China or rates or valuations or whatever, later in the year at some point, the market is likely to shift its focus to an eventual recovery. Often that happens before a recession is over, which means that if the market hasn't bottomed out yet, it probably will in 2023. And at some point during the year, a strong recovery is likely to begin if it's not underway already. Where do I want to invest? Well, in the equity markets, I think it's premature to take a ton of risk right now, but some areas I find attractive are energy and commodities, industrials, Chinese equities, and most of all, high quality dividend payers, which should provide some downside protection and tend to do better in a high rate environment. For more on that, check out my video on the major stock market shift coming here. And if you want to know the 9 habits you need to be a successful investor, check out the link below in the description. Thank you for watching, and I will see you in the next video.